An example, BBVA tried to place on the market so-called covered bonds, 2 billion of those covered bonds, and they were successful, but they had to pay very high interest rate spread on those on the top of those bonds. So what the banks do, again, in August and in September, they go to the European Central Bank, like Portuguese banks, when they're enormously, recently they borrowed $40 billion from 35 billion euros, $40 billion from the ECB. Just to put it in a perspective, in the predecessing couple of months, they borrowed half of this. Spanish banks borrowed 140 billion euros from the European Central Bank. In the previous year, on average, they borrowed only the third of this. Per month. So it is a huge challenge. And going forward, it's worth observing how the capital markets behave from this perspective. Is the capital market a reliable source for new funding? And what about the price for this funding? This has to always be asked, because then this price is going to be transplanted, so to say, on the real economy. And if the price is too high, the demand will be lower, and the innovators and non-innovators won't borrow this capital. So this is the first huge issue in front of the European banks. The second one is raising new capital. Capital was quite well supplemented in the United States after the stress testing was done in the United States in April and May 2009 of the last year. American banks are in a much better position right now from the capital perspective. However, European banks are not in such a good position. And some of you probably heard about the Basel III agreement, accord, to be implemented over the next couple of years, actually till the whole fullness of the Basel III won't be implemented until 2019. And I am worried about this, because actually unless the European banks in particular won't raise capital, they will not be ready to lend money to the real economy. And to put a couple of figures in front of you, right now, according to Basel II, the so-called core Tier 1 capital, so the equity, basically the shares and the retained earnings, it was to be 2%. In the newly created Basel III agreement, the capital will be 4.5% plus additional 2.5% buffer. And if this is not delivered, there will be some restrictions on the dividend payout and on bonuses for the bank executives. And on top of this, for the banks which are deemed too big to fail, you've heard this impression many times, there will be an additional buffer required of 2 to 2.5%, so altogether up to 9.5%. And the bad news is that actually some of the serious and well-renowned economists like Martin Wolf from the Financial Times or William Buter, they think that even this 7 or 9% of capital for the banks, which is to be raised, is not sufficient to cover the losses which will probably emerge on the horizon in due course. So we have to prepare ourselves for a period of pretty long deleveraging. Deleveraging in the banking jargon means lower level of lending from the banks, and the capital creation needs to happen elsewhere in the economy. The banks won't be such a major source of capital as they used to be, as they have been so far over the last number of years. Additionally, even if the crisis is sorted out, or so to say, sorted out, we will have to build, and this goes both for the American banks and for European banks, we will have to build counter-cyclical buffers. because so far the banks on both sides of the Atlantic, they were very much behaving procyclically, and they have contributed to the difficulties in the crisis rather than softening this through the counter-cyclical measures. So over the next 2-3 years, we may observe new capital requirements imposed on the banks by regulators. Now, summarizing all that, what it means for Europe, what it means for the US, I think that first of all, the process of de-risking, so to say, so lowering the level of risk throughout the economy, and the process of deleveraging, so lowering the debt all over the economy, has started rather than finished. We have to be aware of this, and we have to work on different source of capital. The banks have to be sorted out, because if this won't happen, as Diogo mentioned about the Japan and the lost decade. One of the reasons why in Japan there was lost decade, or actually lost 2 decades from the beginning of the 90s, was that Japan did not sort out the issues with their banks, and the bad debts were covered below the surface, and actually they created a kind of zombie banks. They couldn't get out of this vicious circle. Europe and the United States are doing much better now, trying to actually show and not to disclose these real losses, but this means that we will need additional capital. And in order for the real economy to be kick-started again, the different sources of capital, among those, as these which Maciej and Diogo mentioned, the European Investment Bank and EBRD, and these kind of funds have to be triggered, have to be instigated in order to really compensate, at least to some extent, for a very subdued lending environment going forward over the next 2-3 years.